Hello, everybody. Welcome to Friday, another Talk Money with Tom show. We're here today to try to help you improve your retirement, especially in the area of finances. We like to do that by answering your questions. So you can send those in live. We'd love to try to answer those here as we go. You can send them in two ways. You can go into the chat here on the channel and put something in, or you can do an email at asktom@talkmoneywithtom.com, and we'll try to answer those. You can, of course, send in the emails, during the week. We can try to, look up those questions and get some good answers for you as far as that goes. So, we've created this channel because we feel like there's a deficit in, the area of retirement planning, asset management during retirement planning, tax planning during retirement, et cetera. And it's a good way for us to communicate with our clients and others that are out there as far as that goes. But so if you want to subscribe to the channel, you can do that by hitting the subscribe button and then hit the little bell next to it. It'll send you a notice whenever we post a new video. And so you can see, kind of what we're talking about at any point in time. And of course, if you just want to meet with Ethan and I and ask us some questions, whether you're a client or not a client, be happy to do that. You can go to the book appointment button that's up on the top of our webpage. Link for that webpage is here on the channel, and set up a 30-minute time, in-house video, phone call, whatever it works for you. Just ask us some questions. We can hopefully help you. So, looking forward to today's show. Really excited about trying to help anybody that wants to ask any questions and such too. So, I do start off the show each week with just a summary of what I saw happening in the stock market. I do, of course, a Monday through Thursday summary of what happened for that day, kind of things I think had the biggest impact, and then Fridays I try to do for the whole week. And so let's start off with that. Okay, so we've got our, our traditional chart here going back to 2018. And you can see here it's going okay still, right?
Yep.
I mean, yesterday we hit an all-time high. The S&P 500 broke through 6,500, which I think is fairly significant, actually. We continue to recover from that, April drop that we had after Liberation Day. Ironically, the tariffs are almost exactly back to where they were, just a little bit shy of that tariff time frame. And so we'll talk about kind of, why is the market up so much in the face of so many different things? I mean, because a lot of times I think to myself, things could go okay, but then they keep stacking things against the stock market, at least from a traditional sense and the things that I'm used to looking at as far as that goes. So, because I think that there's some danger here, and so the reason that we have 1/3 of our normal stock market allocation out of the stock market and in T-bills is because, when I look at the teeter-totter of what could drive the market forward and what could drive the market down, I'm still obviously up on the side of driving it forward. Is why we still have 2/3 of the market in. So the things I look at that I think are positive for the stock market, first of all, the fact that it's hitting new highs, it's moving in the right direction, the momentum is upward, right? And so, primary direction is up. All the different measures that I would use for 200-day moving average, higher highs, higher lows, all those different types of things. Primary direction is definitely up. And then you've got this artificial intelligence trade, which is, a huge capital expenditure, especially by some of these really big companies, that's definitely exciting the market. Mm-hmm. A lot like what we saw in 2000, although in some ways so far this is better than what we saw in 2000 because these are companies making serious money.
Right? Yeah, like NVIDIA, it's not like they have nothing coming producing.
That's right. And we started out that way a little bit, like in the 2000, we had Cisco, for example, and they were making, really good money. They weren't a big company at the time, per se, kind of like NVIDIA is, or even an older company like NVIDIA is. But we still had some of that, but it eventually became a situation where these companies had no earnings. A lot of them didn't have a product. I still think if we didn't have so many other things on the negative side to drag the market down, we'd still see that here in short order. Over the next 2 years, we'd see this kind of craziness with IPOs coming out from AI companies, whether they had a real product or earnings or what have you or not. I still think that's kind of the same type of euphoria that we saw back then. So, but at the moment, I think that's a very positive driver to the upside. You've got some deregulation coming through, especially with some of the banks. The market likes that. We had that big, beautiful bill with a tax basically cut-ish. I mean, they kept the tax brackets more or less where they were. There were some other cuts that happened there too. But again, that's the market sees that as stimulative. The bond market might struggle with that a little bit. So we'll see what happens, just because the bond market is going to have this kind of $3-4 trillion projected deficit to deal with that they've got to issue new bonds for. So, but nonetheless, you take those components, direction of the market, the AI trade, and really deregulation, and all of these different pieces, and you've got a market that could be moving up. Okay, but on the other side, we have this situation where we have these tariffs, right? And they're starting to hit. And we'll talk about that here in a minute. Starting to hit earnings. We're getting earnings reports now. So I said August, September, October is when we start to see more and more of the impact of tariffs, and that's definitely true. And I think it'll continue to build in terms of what we see throughout those months and beyond, depending on what happens. And so that's a huge deal. We did not have tariffs in the 95 to 2000 run-up, right? Best 5 years in the history of stock market. Similar scenario, because everybody's excited about the internet and the dot-com, revolution, to what we have now with artificial intelligence, but we didn't have tariffs then, right? We didn't have this level of deportation where no matter how many people they're deporting, the way that it's happening is scaring the workers, and a lot of them aren't showing up to work. They're avoiding certain areas completely, and you're hearing a tremendous number of stories from the agriculture, construction, meat packing, businesses where they're, running into problems with getting labor, and that's going to affect the pricing. Either you're going to have less supply of those, or if you do have the same supply, probably those companies have to pay more for the labor to get that to the store, which probably means price increases. We saw, for example, raw vegetables jump up 38.9% year over year last month. Those are the types of things I think that deportations bring. Again, in that 2000 run-up, that we had, it was so exciting. We didn't have this type of deportation where you had people not showing up to work. Okay, so I think that's different. And then the last thing that I think is really on the other side of the teeter-totter here has to do with the fact that you've got a scenario where we're impinging the freedom of the Fed, the independence of the Fed. We've been calling the Fed Reserve Chairman names, literally, for quite some time now, and now we're trying to fire, or we have fired, it's depending on what the courts, I guess, end up saying as to whether you can do this or not. One of the Fed governors, she apparently put down that she had a primary residence in 2 different places, so you get a favorable rate on your mortgage if it's a primary residence. So there's a lot of debate about what that means and how that's going to work, but it doesn't really have anything to do with her mortgage issues. It has to do with trying to assert control over the Federal Reserve. And that's a really, really scary thing to the stock market as a whole, as far as that goes. So again, we didn't have that in the 95 to 2000 run-up either. So that's, I think, we're seeing new all-time highs, and the market is doing okay, in my opinion, and it seems like the dip buyers are still there. Last Friday, the market dropped, and the market came right back after that, right? And markets, are responding to these different things. So I think, lastly, I'd put on the negative side is this concept that, the U.S. produces a lot of numbers that are really important for us to be, to be able to do our work and analyze what's happening in the economy and the stock market. And when you start to fire the people that come up with numbers that you don't like, that's another thing that the market's going to struggle with. And we'll talk about some ways to get around that, but it's a really interesting area. And one of the numbers that came out today was the, PCE price index. Okay, so PCE is personal consumption expenditure. It's the price index. This is the favored measure for the Federal Reserve. This is the core PCE, which means they reduce, take out energy and food. And you can see it's going up, right? It's on a trend here going back from May. It's gone up every single month. It's up to 2.9%. The Fed target is 2%.
Yeah.
Right? Now, if you look at this is the last 12 months. It's kind of volatile. I mean, look at back in February, before the tariffs came, it was actually slightly higher. So we'll see how this plays out. But I think a couple things here. Can we trust the number, right? And now I'm having to ask myself that. I never had to ask myself that before. Can we trust the number? We're having to take loyalty tests in all these different departments and such. And there's supposed to be this kind of checks and balances and separation for some of these things. They seem to be blurring. But let's say we can trust the number. What we aren't seeing, if that's true, if this numbers are accurate, we're not seeing a big push through from the companies, right, into the consumer price. And so I saw one study that said it was something, the low like 14-15% was being paid by the exporter, okay? 60 some odd percent was being paid by the company, and 20 some odd percent was being paid. I don't remember the exact numbers, but you get the idea. It was being paid by the consumer. But the report and the study, said that within 6 months, the consumer would be at about 67% of those increases. So
Yeah, because the shareholders aren't going to be happy with the company if they keep eating the costs.
yeah, and that's the problem right there. So if you keep eating the costs at that kind of 60+% level, first of all, some places you can't do it. I read this one article, this lady saying, well, I can't sell things, for $2. It cost me $5. So she had a store that sold cards, small business, and they get a lot of their cards from Europe and Japan and what have you. And she says we're going to have to raise our prices. I mean, we, like you say, we can't stay in business, doing that. Some of these bigger firms can absorb some of those losses, but even then, first of all, they probably won't, just because that's not what they do. Secondly, there is the obligation to the shareholder, right? So they can't just eat that stuff. And so eventually it's going to come through. You'll probably see it in these charts. I wouldn't be surprised to see a 3 or 4%, year over year jump, in this particular chart by the end of the year, based on what tariffs are doing. And so that makes it difficult for the Federal Reserve. Okay, so I want to put one backdrop on this before I kind of discuss two other issues. First of all, one of the things that we're seeing over and over, I'm getting a lot of information. This is one of the most expensive markets in the history of the stock market. And so just in and of itself, that's not the end of the world. We saw in 2000 where, the 95 to 2000 run, where it just got more and more expensive, more and more expensive. And it could go up 40-50% from here, because at some point in time, valuations sort of disappear. And then all of a sudden they kind of come back, and that's usually when you get those big downturns. Like we did, we had a 48% downturn in the 2000, because it just kept going and going, and the valuations got to be really ridiculous. But on many measures right now, we're actually higher in valuation than we were at the peak in 2000. So this is one measure here. Now, we're actually not higher here. We're second highest, going back to, maybe take that Chiron away. So there we go. Going back to 1880. And so what this is called a Shiller PE ratio. This is Robert Shiller. He's a professor at Yale. This is very well thought of. They take an average of the 10-year earnings on all the companies on the S&P 500, and they factor out inflation. We're currently at 39.18 right now, second highest in history, only after the dot-com bubble.
Yeah.
Historically, when you get over 30, and it's only happened 5 times, the market drops an average of 30%. Okay, so again, could go higher, but we're pretty highly priced here. Okay, so we're priced for perfection, and things aren't perfect. I guess that's one of my concerns. So here's another measure. This is price to book. Okay, so the book value of a company is you basically take the number of shares, and you compare it to the actual value of holdings. What are my machines worth? One of those type of things. And again, it's a weird measure, actually. It's not really well thought of. But on that basis, we are the highest, most expensive market in history at 5.3 times book value of companies, okay? And so here's another one. This is really popular, very, very popular. This is a Buffett indicator. And this is something that, Warren Buffett came up with years and years ago. And that's just, if you take a look at the value of the total value of the stock market versus the total amount of gross domestic product that the country is producing. And right now we're at 217%. So in other words, the market is worth 217% more than the gross domestic product. The average is actually closer down to, 1 or 100%. And so this is the highest it's ever been. Highest the Buffett indicator, never been here before. And here we are. Okay, so again, price for perfection. And then this one's kind of interesting. This comes from Bloomberg. This combines almost all of them. The trailing PE, the Buffett indicator, the Q ratio, price to book, all of those. And you can see we actually just became higher than the Great Depression in 1929 based on all of those measures mixed together. So nonetheless, this is a market that's very expensive. So you always be a little cautious in these types of markets. Again, we could go up 40 to 50% from here. I wouldn't even be surprised. We did that in 2000 in a lot of ways. Everybody was talking about how expensive it was, how narrow it was, all these different things. It just kept going anyway. But again, in 2000, we didn't have tariffs. We didn't have deportations. We didn't have a Federal Reserve's independence being challenged, right? So those are big. All right. So this is a little hard to see, but this comes from Yahoo Finance. And I guess one of my points here is that if we are going to start to question the numbers coming out of the government, like we're going to get another jobs report. Okay, the last jobs report came out, they fired the person kind of in charge of all of these reports, the Bureau, BLS, whatever that stands for. So we're going to get a jobs report. Can we trust it or not? I don't know, actually. Matter of fact, I'll have a high level of skepticism over all these reports going forward. What I really want to focus on is earnings, right? Because the regulations for earnings haven't changed, the reporting hasn't changed, shareholder lawsuits are sitting out there. These companies have a really hard time lying on their earnings. That has happened. Just look up Enron, right? But it's not very common. And so these are earnings reports, and basically what were the hits to corporate profits. So listening to the earnings reports. So Apple says $800 million hit in the second quarter to its earnings from the tariffs. Caterpillar says 1.3 to 1.5 billion in fiscal 2025, right? Ford 2 billion, GE Aerospace 500 million, GM General Motors 1.1 billion, Hershey 180 million, Hyundai 594 million, Procter & Gamble 1 billion. Stellantis, 1.3 billion. Tesla, 300 million for the quarter. Okay, not for the year. The other ones were for the quarter. First one for the quarter, middle ones are all for the fiscal year, and the last one was for a quarter also. So think about that. So that's money that is just disappearing. This isn't going to corporate profits, which would increase the share price. This isn't going to new hiring. It's not going into new research, new projects, new capital expenditure. This is simply a tax that's going straight to the U.S. government. And it still hasn't been described what they're doing with that money, but that's another story. And so this is the problem with this is drain that is there that wasn't there before. Now, the one thing that's interesting here, corporate tax went from 35% down to 21%, right? And so this is a way to kind of bring it back up from 21. We were doing okay. Matter of fact, in 2095 to 2000 run, the corporate tax was 35%. But the problem is the pricing at this level is based on really the 21% corporate tax rate, and not this with the tariffs on there. And so here we are. We're at a point where the pricing is super high, and we're not even counting. Most of these measures of valuation are backward looking, and so we haven't really seen the impacts of what this is going to do to earnings. I think more and more you'll see these companies pass these along to the consumer. But that'll affect them also because now their prices are higher. When you raise price, so the amount of demand drops at those prices.
Demand destruction.
Yeah. So if Ford has to raise the cost of their cars, they're going to sell less cars. And so that's going to hit them on the revenue side. It might be less impact than having a $2 billion cost directly to pay tariffs. If they put that $2 billion cost to the consumer, maybe they lose $1 billion because of reduced sales or something along those lines. So, but I think that is why we're going to see the movement to consumers, even though there will be an impact. If you look at it from an economic standpoint, and I bet the impact is less than actually paying the tariffs directly out of your own bottom line. Okay, and so that's kind of the issue. We're now we can really start to talk about things. And for real, not just looking at, what might be happening. It is starting to happen. These are all earnings reports that have come out here in the second quarter. It'd be fascinating to see how this progresses and keep watching these reports and whatnot and listening to the future projections from these companies. None of this has affected the stock market, okay? So one of the things that is very interesting about the stock market, it does a really good job of making the nuanced moves, but it can sometimes miss the monstrous changes. So for example, in 2008, the market was still going up, even though mortgage delinquencies were really skyrocketing. I mean, people were finding trouble paying their mortgage, mainly because they gave them a mortgage they could never afford in the first place, right? They were giving them to everybody. And, the market hadn't really responded to that. That started in 2005. And 2007 was the peak, October of 2007. Went for a really long time. And then finally it started to become more obvious to start talking about subprime mortgages. But the market still didn't really understand the full impact of that and really the impact of these credit default swaps, which were these insurance policies on top of those mortgages that these companies had to pay off when these mortgages went bust. And we ended up with a 57% stock market return. And so it's one of these things where it's kind of like, it's like boiling a frog, right? I mean, you put a frog in some water and you turn up the heat really slow, and the frog doesn't really realize he needs to jump out of that water until maybe it's too late. And that's kind of what's happening here. We've got this scenario where anybody who really understands how the economy works, how earnings work, how much importance they have, is seeing this destruction of some of those areas and some of those pillars that were holding this market up, and we're already expensive. If we were cheap, that might be different, right? Maybe we don't fall as much. We are very likely the most expensive stock market in history. So, and then we've got these things happening. Why would we continue to go up, right? I don't think the market is kind of missing out. And so either those things will disappear. We'll figure out a better way to do deportation so we can still support agriculture, construction, meat packing, all those types of things. And that's possible. They can do that, right? They can come up with programs to bring people in on a limited basis to do those things. They've done that in the past. Mm-hmm. The tariffs could disappear. Unfortunately, the tariffs are going up. We're up to 19.5 now. According to the Yale Budget Lab, we were at 18.6, but it keeps throwing up new tariffs, new line item tariffs, new threats. I mean, the threat to China right now is because they're slow walking the magnets to us through this rare earth metal, monopoly that they have, and then we're threatening a 200% tariff, which of course would be bad for us too. So it's kind of interesting how that works. But so that's the challenge that you're going to deal with in this particular environment. And then the last thing is really the independence of the Fed, because look, this is a pretty interesting breakdown. The red line here shows what happened to inflation in 67 to 83, and we kind of had these three waves of inflation. And you have to understand this if you want to understand what the Fed is thinking. So, we're looking at this and saying, okay, inflation is going up even as we speak. We just talked about that a little, at least. And unemployment and the job market is getting weaker, as we've seen from these reports. And so what do? If they lower rates, they might create that third wave of upward. And so they know this, okay? This Federal Reserve, matter of fact, Chairman Powell has talked about this multiple times. He does not want to be involved with the Federal Reserve that creates that third wave, because that was very destructive. The Fed fund rates right now is around 4.25, 4.5, and it got to 19% at the top.
They essentially have to break the market to fix inflation.
Yeah, and so that's the fear that they have. I think the one difference here is that most of our inflation might be caused by tariffs. It could be a one-time thing, could be a temporary thing. But actually, we don't know that for sure. It could cascade into other pieces, because now I'm paying more money at the grocery store. I go to my boss, I need to get some more money, and I might work in any business. And all of a sudden, that process and that product gets more expensive, or that company starts to make less money, depending on what they do with those increased wages. So, anyway, that's kind of where we're at the moment. I still believe, okay, very strongly, even though the market has been coming up a lot, I believe that there's some underpinnings here that we have to be aware of and cautious with. And I think a 1/3, market out, and 2/3 in on our normal allocation makes complete sense to me. We're still more in than out. The market is still going up, right? We still have artificial intelligence. We still have deregulation. We still have this new tax cuts. We still have a lot of powerful pieces. We still have companies making good money. Earnings have been good as a whole across the board. Again, we weren't expecting earnings destruction yet, so that's still coming. But
probably third quarter, fourth quarter.
Or I bet you fourth is much more so than third. But yeah, I think we'll start to see more. We've seen some in the second. We just went over those, and we'll see some more, coming forward in those other quarters, in my opinion. But those are all reasons to be 2/3 in. Right? Because if the other side, if the tariffs disappear or reduce, which they can do on a whim, right, at a moment's notice, if the deportations change, which could also change pretty rapidly, you know, the Federal Reserve somehow gets its independence back, some form or fashion of that. These are all things that would then wipe out the negatives, and the positives would be there. And at that point in time, you definitely want to be 100% allocation in. But you know, until that happens, I think a 1/3, 2/3, and that could change. You know, we start to see the momentum of the market fall off and really start to come down. Maybe you want to have a little less exposure just because it could be the beginning of a problem. But September is, you know, historically the worst month of the year, right? It's the 1928 to now, and you know, it's the only month to have a negative rate of return on average, as far as that goes. However, we have the Federal Reserve lowering rates, most likely. 86% chance, according to the market, that they're lowering rates on the 17th, or you know, I think the meeting's on the 17th of September. And so that, you know, could boost the market enough to make it for a decent month still. And the market has been operating on that rate cut aspect. It likes that quite a bit. So anyway, that's where we're at right now. I think it's a very interesting time, you know, to be paying attention to learning and to seeing, because we're seeing things that we've never seen before in our lifetimes. We haven't seen tariffs. We can go back and study what has happened historically. You know, this level of deportation and the way that it's happening, we haven't seen that before. Nobody's ever tried to fire a Fed governor. No president has ever tried to fire a Fed governor. We're seeing things we've never seen. How does the market react? What does it really mean? Does it really matter, or is it just news? Right. So those are things we're going to learn as we go here. So anyway, look forward to being able to talk to you again next week. And obviously, I'll do my daily videos during the week, and then we'll do the summary here on the show. So, all right. What do we have for questions?
Do you think the PCE report changes whether the Fed cuts rates, or is it kind of just the same?
Okay, so the PCE report is the Personal Consumption Expenditure Price Index, which is an inflation report that the Fed looks at. Okay, so CPI is what most people know about, Consumer Price Index. That's reported earlier, but it's a different basket, a different methodology, and the Fed likes PCE better. And so we just ended up with a 2.9% PCE year over year core. All right, that's what they look at. They look at core, not headline. They want to take out food and energy. So that came within expectations, but it's been higher every month for, 4 months in a row now. So overall, I think what they're more concerned with, if you listen to Chairman Powell after the Jackson Hole speech, is that the deterioration in the employment picture. And he painted a picture where employment could basically fall off a cliff if they're not careful, because it can cascade. And of course, once that starts happening, then lots of people don't have money to spend, and you can really kind of spin into a recession pretty rapidly. So yeah, and we've mentioned this before on previous shows. We actually think there's room for a rate cut, because inflation is all about demand, but this inflation is because of tariffs. It's not because people demand more. If unemployment is weakening and the economy is weakening, which it has been all year, you're going to have less demand. Even if you cut rates, you're probably not going to push demand into an inflationary time frame.
Especially with the retail spender just not spending as much money because of the uncertainty.
Yeah, exactly. It's so that I think that's going to make no change. The market had almost no change whatsoever in terms of its guess. I think it went from 85% to 86%, likelihood of a rate cut in September. Right now, the market actually has a likelihood of a rate cut in September, October, and December, which are the next 3 meetings. So, we'll see, what actually happens because we've got a lot of numbers and a lot of information. I do think the second half of this year is going to be way more interesting because we get to see these impacts come through and see if they really transpire and if there's any adjustments that happen from either the Fed or the White House. So we'll see how that goes. But I think there'll still be a rate cut of a 1/4 point. I don't think they'll do a 1/2 point. I don't think they'll do 0. There are some Fed governors who think they should do 0. So it'll be interesting, but I do think they'll do a cut.
Yeah. So what does priced for perfection mean? Is that a bad sign?
Price for perfection, yeah. It's not particularly a bad sign per se. For example, I think we were talking about price for perfection in like 96 or 97 of the big 5-year run, because the stock market had made a pretty good run, especially in 95. It was really a strong year. And so, as it gets more and more expensive, basically what we're talking about is the price of the stock market, or even the price of a stock, like take NVIDIA, or Tesla.
Yeah.
And you look at what that means compared to the earnings. So NVIDIA is selling for almost 60 times its current earnings. What that means is that for if you look at the price, if you look at the earnings, it would take 60 years, right, if we had those same earnings, to equal that price. For Tesla, it's roughly 200, right? Talk about price for perfection. And so, but we saw a great run in the stock market from 96, 97, 98, 99. It kept on going until the end. And so it is just a kind of a warning sign to
Yeah,
me.
it's basically when someone says price to perfection, it means like these companies are running like perfectly. Everything's going right for them.
Right.
There's nothing wrong. A lot of times when people say price to perfection and they're referring to a single stock, usually they're trying to refer to it as overvalued.
Yeah, that's right, and they're not wrong. But companies' valuations are kind of fungible for quite a while, and then they can kind of snap back around to become more important. But in the period of time that we're in right now, valuations are definitely fungible, and people are willing to look past. We're not in the crazy time frames where we have so many companies making nothing, doing really well. We do have some, that's for sure. Quantum computing area is really hot, even though it's still yet to make really money. And so, those types of things. So that is happening, but yeah, exactly right. NVIDIA is running perfectly. They are priced for that perfection. If they stumble, even the most minor things, like they had a little bit of a drop in the data center sales, in the last earnings report this week. Their stock after hours dropped 4%, but it's such a good company and so interesting to people and has such a good market share. That's not going to hold, right? It'll come back up. The dip buyers are going to come in and buy on that, but that's why it sells off. It just, the numbers have to be absolutely ridiculously good to have it jump at this point, and the expectations are very, very high. And that's happening across the market. This is the most expensive market, it looks like, in history, right? So our market is priced for perfection. To me, that kind of creates this scenario like, oh, okay, if we're priced for perfection and we've got tariffs and deportation and we're attacking the independence of the Fed, I'm like, whoa, that's not perfection. That's not what we had in 2000, in that run, 1995 to 2000. So I think it's sort of a bad sign right now in the overall stock market, but it doesn't have to be. We can still run up quite a bit. I've seen it lots of times. Trading purely on valuations probably works the best if you're trading the opposite side, where you're buying really low valuation pieces, a little bit like what Warren Buffett does, more than he used to, more than most of us do, versus, selling because the valuation's too high. It can go higher and higher and higher. You can't, you can't underpin a greed. It just continues to go, and people keep pouring money in. So, yeah, it's an interesting question. All right, what else do we have?
Who gets the 1099-Q on 529 distributions?
All right, so 529 is an account that you would set up for a child, grandchild, something along those lines.
Educational fund of some sort.
For education. It grows tax-free until you take the money out. Take the money out as long as you're taking the money out for some educational expense.
Qualified expense, you get tax-free growth.
Yeah, and they've broadened what a qualified expense is, which is nice. They're really nice vehicles, actually. And so, but when you take money out, somebody has to report it. It's not taxable, right? As long as that distribution...
As long as it's going to a qualified cost, it's not...
Right. But it's the question of where it goes, right? Yeah. So let's say that I have a 529 in my name and my son is the beneficiary of that, and I'm saving for his college. And so somebody's going to get a 1099-Q depending on the way we do the distribution.
Yeah. So if the account owner gets a distribution directly to the account owner, it'd be in their tax account. So if Tom was the owner of the account and then he had basically the distribution go to his bank, then he would be it. If it goes to his son's bank account or the institution, it would then end up on his son's tax return. So the 1099-Q would be made out to his son.
Yeah. It's not a big deal, although you may have a son that doesn't do a tax return, so we have to deal with that.
Yeah,
But
it gets a little iffy if there's unqualified expenses.
well, you definitely, yeah.
That's where then that becomes a bigger issue.
We haven't seen that, right? I haven't seen anybody take anything out that was unqualified.
People are pretty good about it.
Yeah, it's you know, even in times of duress, people have left their 529s alone, and you can cash them out, and pay the penalty and taxes and whatever. You know,
Yeah,
it's not-
because it's just it becomes income tax
Right,
basically, and
right.
then it's pretty expensive actually to cast it out.
Yes, it is. All right, what's our next question?
How do we maintain trust in the government reports if we're losing? Can we maintain trust in the government reports?
Yeah, that's a good question. We talked about that a little bit in the summary today. Just, the concerns. Like today, we reported the PCE inflation number. And, for the first time, we're starting to see people, including myself, economists, there was some 200 economists signed some letter, expressing, their concerns about whether or not the numbers were going to be accurate. This is highlighted by the fact that, the employment number that came out the last one that came out had a huge revision to the previous 2 months, and it was quite low for the month that they were reporting on. And so the White House fired the person who was in charge of reporting those numbers, saying that the numbers were political. And so we've had a really good success as a country, and it's one of the reasons we do better than, say, China, because China has real problems, at least from a perception standpoint, about their numbers. Are they accurate? Are they making them up?
Yeah.
And so you start to become a country that starts making up numbers, you'll have a country that's worth less. I guarantee it.
It's just a trust factor.
Yeah, yeah, and the U.S. has high trust factor, at least it did, and we're kind of eroding that, and that's why we're seeing some problems with the dollar and what have you too. So, yeah, I think it's a real threat, and I think it's something that I wouldn't be surprised to start seeing numbers that don't quite add up. However, the way around that are some of the numbers that the government will really have a hard time dealing with. First of all, the stock market itself, if it's falling apart, even though the numbers are great, the market knows, for the most part, especially that area pretty well. But earnings, right? Because earnings are the main driver of the stock market. So that's why we kind of highlighted some of the earnings reports in today's summary, is because that's what you want to look at. If you want to see what the impacts of tariffs are, I probably wouldn't ask the government. I'd probably just look at these earnings reports and try to figure it out.
It's hard. A company has a much harder time falsifying their data.
Yeah, obviously it can be done, but it is kind of rare. The regulations are pretty strict, and maybe most importantly, the shareholder lawyers that are sitting out there just chomping at the bit to sue these big companies when they misreport something.
Yeah.
Right, because it affects the share price one way or another, and so that keeps those companies in line. Those are the numbers that I'm going to be focusing on more and more. Yet we're still, half of the show we talk about the report numbers that come from the government, the gross domestic product numbers, the employment numbers, all of these are derived from, and the inflation numbers, they're all derived from government sources. And if those sources are loyal, to the president or whatever it might be, and they start to put numbers down that aren't actually true, wow, you're talking about a totally different country.
It's a slippery slope once you start to do that.
It really is. It would be quite disturbing. However, again, there are ways around it, and it's not the end of the world. They can say what they want to do. The stock market's going to figure it out, and it'll react one way or another. And earnings aren't going to probably be impinged no matter what you want to have happen there. So there are some kind of checks and balances on those numbers in a way, right, that are out there that are just, too hard to manipulate as far as that goes. So, all right, good. It's a good question.
Why is the market doing so well in the face of tariffs being so high? We've never experienced such high tariffs. It fell in April once we hit that when they were announced, but we're kind of back at that same point, but the market's still doing well.
Yeah, I think that two things. Number one, there's a big chunk of the market that probably thinks the tariffs will disappear because Trump will back off on the tariffs if the markets or the economy starts to fall apart. and hopefully you're getting accurate numbers, so
Yeah,
he realizes
but
when
there's
that's
also a
happening.
fear that the tariffs become kind of an addiction in a sense for revenue.
Oh yeah, that's happened. I mean, look at the Biden upped 300. I mean, upped most of the tariffs that were put into place in 2018. He renewed.
Hmm.
So exactly right. I mean, even a party that supposedly doesn't like tariffs as much is renewing tariffs that were there before. However, if they're destroying the economy, they'll move, right? I mean,
Yeah.
because again, if you look at the charts for tariffs long term, when they get this high, they don't stay there, right? They always have these little peaks on the chart. When we talked about this a couple times, and that's where we're at. So tariffs, and so that's the other weird way of looking at this. If you look at that and say, hey, these tariffs are temporary, then that takes that whole shadow off of the negative side of the equation of what's working for the market and what's not, right? And so, there could be a belief there also that look, the tariffs are temporary. We have all these other positive things with AI and rate cuts and deregulation and everything. And if the tariffs aren't going to be here by the end of the year, or beyond a little bit beyond that, because they're not working and they'll be removed, because historically the tariffs have never stayed up at this level and
Hmm.
plateaued out ever. So it's not going to be different this time.
Yeah, and
It's not.
there's also just a lag period when you
Yep.
announce a tariff and then when it
Right.
actually starts to affect a company. You have to deplete your inventory. You have to be importing back more inventory that, with tariff costs to actually then pass it on,
That's right.
and that's going to take a few. That's going to take a lag period.
That's right. And we're still kind of in that lag period, although we are now starting to see it. Like we saw these big impacts to these companies that reported earnings here in the second quarter, and we'll continue to probably see more of those impacts, and then eventually we'll start to see that impact to the consumer. It is a while. The stats and studies that look back to the 1930 tariffs said it was about a 6 months to be a real impact, and we're well within that window, especially since we've had tariffs starting at all kinds of different times. China, Canada
Mexico.
and Mexico were kind of the beginning.
Hmm.
But we've, just the beginning of August, we had a whole bunch more come on. So,
Yeah.
what is 6 months? I don't know. I mean, it's somewhere, it's somewhere at the end of this year to the first quarter of next year. And so that, we're still waiting for that kind of to work its way through. We saw it, we've been demonstrating this. You look at the surveys on the manufacturers, they say they're paying more. Then you look at the big jump in wholesale prices that
Hmm.
just happened, right? And then you're starting to see, these earnings reports come through showing impacts from earnings, reported impacts, and eventually you're going to see that on the inflation reports,
Yep.
right? It just takes time for that to work its way through. So yeah, that's why the market's still hanging up there, I think. And I do believe. I mean, you look again. These are big. Ray Dalio, he's huge. He called the 2008 downturn. He called the 1989 Japan downturn. I mean, he's a huge fund manager, and he's out for all intents and purposes because he's worried about the overall debt level combined with the tariffs. So the debt level creates a scenario where you have so much money going to service the debt, and it continues to grow. On top of the fact that you've got these tariffs, which slows down the economy, which could lower tax revenues,
Hmm.
right, and such too. And he calls it a debt bomb as far as that goes. And if we have a big downturn, can we do what we did back in 2020 or 2008 where we funnel a bunch of money out? Can the bond market handle that, or will the bond market resist,
Hmm.
right? And if that happens, then you're going to have a stock market that really has a hard time. So that's that money is out and waiting. Just like our 1/3 is out and waiting. And so, the money that's left in there is these retail traders. I read that, the average retail trader's under 40 years old. They weren't even here for the 2008 downturn. And so them, it's buy the dip, buy the dip. Because, man, since 2008, that's what you did. It worked
Hmm.
great. Buy the dip. Until the market falls apart and you end up with a 57% downturn like we did in 2008, or a 87% downturn like we did in 1929, you can still buy the dip, but you're going to have to wait a long, long, long
Yeah.
time for that money to come back to you. So, yeah, right now it's the Buy the Dip group that's running the show, and you can see it on a regular basis. Last Friday we were down, we're back up, new high this week. We were down legitimately last Friday based on the unemployment reports and different things on those lines, and so yeah. Anyway, yeah, it's a good question. Okay, well that's our show today. I want to thank everybody for coming. There's a lot of really important things to be talking about right now. to be understanding what's happening. Hopefully everything blows over and things go really well, but it is important at this point in time, I think maybe more important than a lot of different situations, to kind of understand what's happening. So that's what we're trying to do, trying to bring that to you and such too. We'll be on the record with what we thought was going to happen. We're recording this and putting it on our channel. So anyway, look forward to being able to see you again next week, but we've got some situations where you can send in questions between now and next show. Ask Tom at Talk Money with Tom. You send them in anytime during the week. Happy to answer those. If you have a question, probably somebody else does too. You can go to our channel if you want to kind of increase your education. Hit the subscribe button. If you haven't already, do the little bell to get new, notified when we do new stuff. Or if you just want to meet with Ethan and I, whether you're a client or somebody else, feel free. We've got a book appointment button up on the top of our website. The link to that website is here on the channel. And we can do a 30-minute, call, meeting, face-to-face meeting, or a video with you. So look forward to being able to help you again next week, and we'll see you then. Thank you very much.